Investors are concerned about an equity market's correction. When would it come? Will it come? And if it does, where should you be positioned? We're joined today by Ted Oakley. He is a founder and partner of Oxbow Advisors. Ted is a macroeconomist and an investor, and I'm looking forward to speaking with you, Ted. It's your first time on the show. Welcome to Kitco.
Thank you, David. Glad to have you.
Yeah, we're going to be running through the gamut of your overview on the markets, starting with just a very general question that's on everybody's mind. Are you bullish or bearish on stocks right now?
Well, David, I've probably been through more bear and bull markets than most people just because of length of time in the business. But where we are right now is this: under almost any measure you want to use, and we use 10 to 15 measures, but the macro market is very, very expensive. In fact, it's as expensive as it's ever been in the history of the numbers we run. So for us, what that's meant, it doesn't mean for us that we get completely out of the market or anything, but it does mean when we can't find anything else to own, when we've sold something, we keep that cash handy. And so right now you'll see our cash levels are probably somewhere between 30 and 35%. Not saying it won't go higher, because they could, but that's where we are right now.
That's the highest cash position I've heard of since I started doing interviews. Ted, care to explain why you're so defensive right now? Are you expecting a correction? Is that why?
Well, when you look at it, what happens is the reason we carry that type of number, and we've had, I'll give you some term, in 2008, we had about 40% liquid. In 99, going into 2000, we had probably a little over 40%. So you never know when things are going to change and when you get some selling. But you've heard this term, buy the dip, but I keep telling people that if you don't have any liquidity, if you don't have an insurance policy, you can't buy the dip. And it depends on type of money it is. But for people that have finite money, in other words, they're managing what you have. It's not like a pension plan where you have money coming in every month. Then you have to decide where you want to be. And for us, what happens is we just don't have things out there that meet our criteria for buying. So when we have that, we say, if we're not going to find something that's a good value, we don't buy it.
So you're value investors. Okay. If I could make that generalization. Ted, I'm curious to how this allocation to cash has progressed over the last year and a half. Where were you, let's say, in terms of your cash allocation in December 2019? Where were you right before the crash of March? And how did that change throughout the pandemic?
David, we were about the same. We were probably around 30% at the same time. If you looked at in January of 20, December 19, same way. And when we got to selling in March, we allocated some cash. We allocated probably half of it. And we also made some adjustments. We run 4 different strategies, but over in the strategy where we have oil and gas and real estate and things like that, we actually, we didn't change the allocation as much as we upgraded. That gave us a chance to really upgrade to better quality in some cases. But on the stock side, we put about half of that. And then as we got through the year and coming into 21, if it hit our target, we usually have 5-year targets, you see. And if something hit that target, we cut back on it some, and we really have sort of gotten back to not quite where we were then, but our cash levels are back up for sure.
Before we talk about your macro outlook and specific stock sectors that you like right now, I'd like to touch on this cushion of cash here. Now, our audience is familiar with gold as a safe haven asset, or at least that's a common belief amongst people who buy gold. They view it as a safe haven asset, among other things. What's your view on gold? And I wonder why that 35% cash isn't, let's say, 15% cash, 15% gold.
Well, I'll give you an example. We like gold. We came into our biggest returns really for 19 and 20 were gold and mine. We had a fairly large position in 2 of the strategies. Now, we have a growth stock strategy, which we do not own gold in, because it's really growth companies. We're looking for companies that are growing at 15% a year. But in the other two strategies, we have a high income strategy and we have a conservative income strategy. We own the gold and the miners in both of those. And we did this for this reason, because we think that gold will outperform as the dollar fades away, sort of a fiat currency breakdown. What we did, though, was we cut back on it. When gold got up to 2,000, we cut back on it some. And we did cut back on some of the miners. They ran away on us some. But about 6 weeks ago, we put about half of that position back on. And that's where we are now. And we carry as a hedge on the dollar side, we carry in both of those income strategies, we carry gold in those strategies.
All right, so you cut back on the top. Ari, how do you view gold now? We've fallen back from the top, obviously. Now we're in a tricky place. Where do you? What's your outlook?
I think it's in a trading range just for the time being. And I say that I think that trading range is probably, 1,700 to maybe 1,850 or something. I don't think it's quite ready to go. I would guess that we would spend more of the summer a little bit in this range. I know it's moved up recently, and the miners have moved up over the last 2 or 3 weeks. But I think what you'll find is that you'll probably stay in this range. And I'm not certain that the move up in gold the last 2 weeks has not been because you've had the weakness in cryptocurrencies. I don't have any way of empirically proving that up, but that's what that's just a personal opinion.
All right. Now, let's go back to risk assets. The S&P 500 has been trading in a range for the last couple weeks. Now, in your opinion, Ted, what are the biggest risks for stock investors right now to watch for?
Well, the biggest risk you have for stock investors, I think, is that everyone owns a lot of exchange-traded funds, a lot of index funds. We don't own those. That's not how we invest. We invest in individual companies. But the problem with that is you look at a lot of those, and I'll give you a good example. A lot of people, if you take ARK, ARKK, which was, we don't own that, but it was 158 or so, goes to 100. I'm not certain people know what they own now. They've spent 10 years just buying line items like exchange traded funds or index funds. And I think when you eventually get an extended bear market, I'm not talking about a March where the Fed saved you, but an extended bear market, I think you get into a situation there to where it will just chip away at those and everybody's selling the same thing, see? And that's one of the problems I think you'll see. And, to me, this one is just about like it was in 2000. I thought the market was so crazy in 2000 that we would have a significant bear market, and we had one. So I would suspect that somewhere off of this, it may not come this year, but there'll be significant damage in this one too.
Okay, let's talk about the significant damage. Now, I remember way back when I first started working in finance before my current job, one of my managers, first thing he told me was that, David, look at this valuations chart. It looks overstretched, right? But value is the poorest indicator of price movement there is. And so just because something's overvalued doesn't mean it can't go up any further. Now, in the last year, we've experienced COVID, we've experienced rising inflation. We've experienced money flowing out of the stock markets and gold into cryptocurrencies. There's been a lot of challenges to equities, but yet we're still at all-time highs. I wonder what's going to cause this significant damage, Ted. What's the trigger? It looks like we always need a trigger.
Well, you could have a couple of triggers, David. I think the one trigger you would have is you have to watch and see if either through physical or through monetary that they're going to keep on pushing money out. That's really what's caused this. If you look back the last 10 years, this all had to do with the Federal Reserve. It's been unfortunate because they took away what should have been these ups and downs in the economy. They should have taken poor companies out of the economy. But the Federal Reserve has taken it upon themselves, which, by the way, is unfortunate, okay? It'll probably be one of the worst things we look back on that's happened. But they spent 10 years of keeping the money flow on. And in the last 2 or 3, they've really done it in a big way. And so there's two things would happen. One is you would either get into a situation where they can't control the upside inflation side because there's too much money, or you go into a situation where there's so much debt that it really pulls everything down, and all of a sudden you go the other way where you sort of disinflate or deflate, and people realize that, hey, obviously everything really is overpriced, and so you get into that selling. There's a point in time out there where people sober up, but there's typically a reason for it, but you won't see it now, but it'll be something out of the blue that gets it started. But the main reason once it gets started is overpriced.
Now, Ted, you've experienced the last few rounds of quantitative easing throughout the last decades. Why is it that all throughout 2009 to up until basically last year, we've had very little inflation despite 4 rounds of quantitative easing? What's different this time?
Ron, I think the biggest part of that had to do with the fact that if you look at the wage side you look at what corporations have done, okay? They've basically done this type of setup. They paid the average worker no more money. They weren't making any more in 19 than they were in 2010 on an adjusted basis. They were basically the same. So wages hadn't caught them at all. Technology had really come around. And so they were able through technology and really global enterprise to keep prices of cost of goods coming in at a really, really low point. And the other thing that happened, and this happened over a 15-year period, as the internet grew as a form of marketing and advertising and everything else, it's not like it was 20 years ago or 25 years ago, where if somebody raised prices, they could get a price raise in and make things move a little bit. Now, if somebody raised prices, you had 4 competitors the next afternoon that said, hey, by the way, we'll do the same price. Matter of fact, we might do it even a little better than that. So you went through a whole period like that when you didn't have any of the input costs going up, and that's why you kept the same way it was all the way through.
All right. Well, wage pressures haven't yet hit the United States, have they? Will they?
I think they will. Yes, I think they have to. Actually, if you look at it, they moved a little bit. If you look at margins of companies, we track really basically profit margins, and we track it against cost of labor, and margins are at the very, very high peak of where they ever would be, and really labor's down here. And so what happens is when you see those two really move toward each other, then you're into it. And we're starting to see both of those turn a little bit.
Now, as an investor, which is a bigger concern for you at this juncture right now, inflation or deflation? Because remember now, I bring up deflation as a possible scenario because people have been comparing our country to Japan in the early 90s. Back then they had monetary easing, but yet no inflation whatsoever and stagnating Nikkei for 20 years.
One of the problems I think what would bother me, what's harder to handle for us really is because we have a lot of fixed income that would be fine if you deflate it from here, that we've accumulated over the years and in different things, not only in bonds but in stocks where we've got some really significant sources of cash flow. But on the inflation side, the problem you get into there, and would be the biggest problem for us, is that we have a number of people that we manage for across a spectrum. So they'll have some growth stock and they'll have some high income, but they'll also have some conservative fixed income. And for people in those categories, they get murdered in a higher inflationary environment because every time they buy a bond, let's say, and 90 days later, they're underwater on it because the new coupons coming out are higher than the old ones. And I experienced that during the early 80s. And so you had to keep everything really short because by the time it came due, your coupon level is already higher than the one before. And so it's a harder management piece.
All right. Finally, let's talk about your investments. Many people I've spoken to privately share your concern, but they don't want to be, more than 30% in cash because they're afraid of losing value to inflation. So they have to deploy it somewhere. So if you had to deploy all your resources somewhere, where would that place be, Ted?
Well, I think most investors today, which listen to Wall Street, which we don't listen to, but I think what happens is Wall Street's got them over in a standard 40% of 60% stock, 40% bond portfolio. And I think if you look at it, commodities are at all-time lows versus the S&P 500, for example. Even though they've had a move, they're still very, very low on a relative basis. So I think the average investor needs to look around and say, okay, what could I own here in addition to what I have? And I think if they don't own some timber and some real estate and some metals and some agriculture, and oil, I think they're going to find that they'll probably be left behind in that respect, because you have to. That's the addition you probably need to add that most people don't have right now.
What was your top performing sector in the last year and a half?
Well, for us, easily the top performing sector for us would have been technology, because we not only do we own it, but we bought it cheaper again. And I don't know that will be the case going forward, but that's what that in the last 12 to 15 months, that was what it was.
You're right. Technology was one of the best performing stock sectors. Are you expecting any sort of capital rotation out of that sector, given how much has already went up?
I think you'll get rotation out of the nonprofit. When I say nonprofit, I don't mean charitable. I mean they don't make any money.
No, I get it. Okay.
Technology company. And so I think what'll happen is you're starting to see that now. People are looking around. If you look at it, they're looking at SPACs that don't make any money. There are a lot of companies in the Russell 2000 that don't make any money, and I think they're looking at those companies and saying, "Hey, we're going to sell those companies because we need to go where companies are making money." That said, though, if you look at the technology of companies where they will make money, where they will hit those 12 to 15% targets over the next 5 years, you need to own some of that. I mean, because that is probably where the growth is. I don't think you're going to find that growth in just standard consumer type stocks.
I understand. Finally, Ted, can you share with us a few names of stocks that you own that you do like?
Sure. If you look at I'll give you two different sections. Okay.
Sure.
I'll give you the income side. I'll give you the stock side. Let's say the stock side. If you look at a new company we've been buying is ServiceNow. We own Microsoft. Amazon got cheaper. We obviously picked up more of Amazon. We own United Health. We like healthcare in that same segment. We obviously like companies like PayPal. We're looking for companies where no matter what happens in the economy, you're still going to be using those. As an example, MasterCard we own. You'll be using MasterCard. You may not use it as much, but you're going to be using it over a period of time. On the income side, we really like oil and gas as an income item. You'll see where we own 3 or 4 of the top master limited partnerships, gas pipelines. We own a couple of straight up energy companies. And then you'll find where we own, and those would be enterprise products. We own MPLX, which is the old Marathon lines. We own Kinder Morgan. And then you'll see us where on the real estate investment trust side, we really like the medical REITs. You'll see we own Omega Health, and we own hospital trusts, those types of things. We've got 4 of those. So those are some areas. And then on the really in that income side, you'll see where we own companies like Roche Drug, which is a great 4% dividend. You'll see where we own Nutrien, which is a fertilizer company. You'll see we own, with some of the timber companies. So those companies, all those companies pay cash flow, which we think will be important over the next few years. So it's kind of a two segmented portfolio, but some people put more money in our income strategy than they do the growth, and some do reverse.
All right. Well, Ted, I appreciate you sharing with us your other 65% that's not cash. Fantastic insights. Thank you very much for coming on the show today. I look forward to speaking with you again.
All right. Thanks so much, David.
Thank you for watching Kitco News. I'm David Lin.